eyes on the labor market on this last trading day of August. Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Bonnie Quinn, and we're kicking you off to the closing bell here in the United States. Well, we had a triumphant week, really, for U.S. stock bulls, but it is fizzling just a little bit now, and you can see the S&P 500 is up about 0.1%. It was lower a little bit earlier. There's some individual stock stories in there that we will be getting to at a certain point today. The Nasdaq 100, as we know, it's not unusual that it should be higher than the S&P 500. It's up about 0.4%. Of course, we got that inflation data, which showed that the core PCE deflator was coming in just at around 0.2%. So that calmed markets. That was a benign reading. We also obviously had the JOLTS data, which showed that perhaps we're seeing a little bit of rebalancing in the labour market. We'll have to see if that continues tomorrow morning. All eyes will be on that report, and perhaps that's why we're seeing a little bit of a sort of, calm churning of the waters here. Definitely a bid in treasuries. The 2-year yield at 4.865%. That's been the same for a day or two now. And a bid in the dollar index. I do want to point out, though, that we have had a 4-day run now for the S&P 500. And we'll have to see if we have a fifth.
That's right. Yeah, of course. It does feel like we're in a holding pattern, like you mentioned, because you look across the board, trading volume much lower, of course. And we know that we're heading into a 3-day weekend, and that also we also know that the Fed's jobs report that, of course, they're going to be looking at very closely is tomorrow as well. So we'll see what happens there. Of course, you can see that the S&P is barreling higher, and that September is one of the worst months on record on average for the S&P 500. So we'll see if we get there. But like I mentioned, we do have that jobs report tomorrow, and it's one of the last ones, the last one before the Fed's September rate hike. What that means for the Fed's path forward, Wall Street a little bit divided right now after we got some mixed economic data this morning just from initial jobless claims and also that core PCE. So right now about even hot odds when it comes to a November rate hike. And Bonnie, of course, what the Fed's path forward matters a lot for leadership in this market.
Well, is it done or is it not done? Is it going to be done at next month's meeting? We are expecting a pause, but maybe the one after that or the one after that, there might be even another hike if we do see inflation continue to increase and, of course, the U.S. economy to continue to heat up. Can't really say for sure right now. We are in that holding pattern. I did want to point out, though, that some of the narratives beneath the surface of the stock market are still in place, including that mega tech leadership. It's coming back. All of those stocks that we were sort of watching in awe when they were rising in the last 6 to 7 months, well, they're right back. Look at this, the equal weighted index versus the non-equal weighted index. And you can see that we're at the strongest in 2 years right here at 0.74. Does that continue? Well, that's the question that most investors are asking themselves.
It's a big question right now, and luckily we're joined now by Quincy Crosby. She is Chief Global Strategist for LPL Financial, going to help address some of the big questions hanging over this market at a pretty interesting juncture, Quincy. It feels like, okay, we had decided that the narrative was bad in August, then we saw this lift to end this month. As we head in towards September, which of course is seasonally a pretty terrible month for the S&P 500, what's the mood music on stocks right now?
Well, when we look ahead to the end of the year, from the end of July to the end of the year, the statistics, the historical picture looks very good. We had a very strong move from last year till July, the beginning of the year until the end of July. And typically, historically, the market should close higher. In addition to that, it is very rare that you have 2 years of a market down. And that was unusual. It was, 1999, 2000, 2001, and 2008, and 2009. This year does not fall into that pattern. We have the presidential cycle, and we have companies that are actually doing quite well. So it's not a given, by the way, just because of the historical negative seasonality, that September is a horrible month. But we should be prepared for it. And the financials, they're under pressure, but the big tech, as you said, they are coming back. And the semiconductors overall are coming back. We want to see that because they are a major leading indicator. They are a barometer for global demand.
It's interesting to hear you say that, Quincy. Talk a little bit more about that. When you're thinking about what's the bellwether here, what are the canaries, if you will, that you should be watching? Sounds like the semiconductors.
Well, absolutely, because if they start pulling back in a material way, it's very difficult for the rest of big tech to keep moving. You know, we have to remember that NVIDIA, basically a semiconductor name, they were well known in the gaming industry as the semiconductor part of the market. Now up there with the big megatech names, pure megatech names. So if they start pulling back, you can expect, I think, the market to say, we're seeing a slowdown coming. It spreads beyond just technology when the semiconductors are pulling back. That's how much of a bellwether they are. And in fact, I want to point out, when this bull market was born, the semis led, big tech led, but we did not see transportation leading. And that worried a lot of people, maybe old fashioned, but then we heard the counter argument, and that as well, the semiconductors are really the new transports.
Quincy, with all your background in fixed income, are treasuries a screaming buy here, and where, if so?
Well, yeah, I mean, they are attractive. They're providing an income. They are, what shall I say, on the short duration side, they're well. And but if you believe that the economy is slowing and that we are due for a broader slowdown, you probably want to go out long duration, because then you get your capital appreciation plus the yield. But if you're in short to maybe the belly of the curve, I think you'll do very well. Investment grade corporates are doing well, high grade. I would stay away from high yield. I know that that there's tremendous attraction to it because they've been doing well. They're pretty tight in terms of the yields, but September they have kind of a negative profile because September could be difficult. Maybe it breaks the cycle this year, but we would say stay away right now.
Quincy, what are you anticipating in terms of issuance for corporate issuers now as rates sort of maybe peak, or at least are close to peaking? Does issuance continue? Will it be attractive?
Yeah, I think issuance is going to continue. And I think that as the yields pull back a bit, if they continue to pull back, you're going to see attractive offerings and bidders for it. There's attraction for corporates. There's attraction for the treasuries.
All right, Quincy, got to leave it there. Really appreciate your time on this final trading day of August. Our thanks to Quincy Crosby of LPL Financial. Now, coming up on the close, we'll get a preview of tomorrow's highly anticipated U.S. jobs report. We're going to do that with Elise Gold. She is senior economist at the Economic Policy Institute.
Plus, shares of UBS soar after the bank posts a record profit and outlines major cost cuts following the acquisition of its former rival Credit Suisse. We'll have the latest on what UBS is planning. And we'll get insight on the climate for ESG investing in conversation with Stephen Meyer, CIO of New York City Retirement System. All that and more coming up. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Well, the Fed's preferred underlying inflation measure posted the smallest back-to-back increases since late 2020. But at the same time, we also saw spending jump. So let's break it down now with Bloomberg U.S. economy reporter Reed Pickard. And Reed, it's interesting, again, to see inflation cool, spending pick up on the latter part. Is that spending sustainable?
So, we saw this huge burst in spending in July, and it was driven by things like Amazon Prime Day. We saw increases from utility usage as this heat wave drove people to spend more on their air conditioning. But in terms of looking forward, it's not clear whether it's sustainable. One hint that we have was the savings rate, and we saw this savings rate really decline in the month to its lowest level since November. And when you do see this decline in the savings rate, we saw a pullback in inflation-adjusted disposable income. It does suggest that this burst of spending that we saw will be hard to sustain going forward, especially with the headwinds of declining pandemic-era savings and the resumption of student loan payments.
And of course, Reid, even if some of this data, was nice thing to see for the Federal Reserve and even for investors, it doesn't necessarily mean that people are not still going to feel the bite of inflation, right? The overall figure was still, quite high. The core PCE deflator year over year was still 4.2%.
Right. So these year-over-year numbers are still, quite high, especially on that core number. We've really seen a lot of progress over the last year in terms of inflation moving towards the Fed's target. But I think it was really clear when we heard Powell speak at Jackson Hole last week that the Fed is far from done. And when you see that high level of year-over-year